Hello, fact finders. Welcome to the channel where we discover the truth and uncover the world. In this episode, we will be exploring 3 assets that will make a depression the best time of your life. What if I told you that a financial depression could be the best time of your life? Sounds impossible, right? Well, stick around because we're diving into 3 assets that thrive during economic downturns. Assets that could set you up for long-term success when the rest of the world is panicking. During recessions and depressions, savvy investors don't just survive, they thrive. These challenging times often present golden opportunities, and today, we'll show you 3 assets that have a history of flourishing when the economy goes into freefall. Can't wait to find out these assets? Sure, I am too. Let's dive into it. Asset 1. Gold, the safe haven. This one's a classic, and it's something that stood the test of time, literally. Imagine this. The stock market's in freefall, unemployment is skyrocketing, and people are scrambling to find safety for their money. In moments like these, you'll hear a lot of talk about safe havens. And when it comes to safe havens, gold is usually at the top of the list. Why is that? Well, gold has this unique ability to retain value, even when everything else is losing it. Let me ask you a question. What would you rather have in a time of crisis? Stocks in a company that might go under, or something that's been valuable for thousands of years? That's what makes gold so attractive during depressions or recessions. It's a tangible asset, something you can actually hold in your hand, that isn't tied to the success or failure of any one company or government. Gold is what I like to call the ultimate insurance policy. Think of it like owning a lifeboat on a sinking ship. The markets may be sinking, but your gold? Well, it's floating, and maybe even rising. So, let's explore why gold performs well during economic downturns. First, it's important to understand that gold is independent of the financial system. When the stock market crashes, or when governments start printing money to stimulate the economy, the value of paper money can drop. But gold holds its value because it's not something you can print more of. There's a limited supply of it in the world, and that scarcity makes it valuable. Here's a quick analogy. Imagine you're playing a game of Monopoly. In this game, there are only a certain number of $100 bills in circulation. Now, what if the bank decided to start printing unlimited $100 bills? Suddenly, those $100 bills aren't worth as much anymore. But if you owned, say, a rare property on the board that no one else had, that property would still be valuable. That's what gold is like in the real world. It's that rare property that maintains its value, even when the financial system is pumping out more and more paper money. Let's talk history for a minute. During the Great Depression of the 1930s, when the stock market crashed, gold prices were fixed, but the gold standard played a crucial role in stabilizing economies around the world. Then, in 1971, President Nixon took the U.S. off the gold standard, which allowed the price of gold to float freely in the market. And what happened after that? Gold became an even more popular hedge against inflation, economic instability, and financial crises. Take, for example, the 2008 financial crisis. The stock market tanked, banks failed, and investors lost billions. But gold? It shot up in value. From 2007 to 2011, the price of gold went from around $650 an ounce to over $1,900 an ounce. That's nearly a 200% increase in just a few years. While stock portfolios were shrinking, those who held gold were seeing their wealth grow. Why? Because in times of fear and uncertainty, people turn to assets that are seen as stable, and gold fits that bill perfectly. Now, you might be thinking, is gold really that much better than cash? That's a fair question, and the answer depends on the situation. During a financial crisis, cash can lose value if inflation takes off or if governments devalue their currencies. But gold, being a real, tangible asset, tends to hold its purchasing power. Think of it this way. An ounce of gold today buys roughly the same amount of goods as it did 100 years ago. Can you say the same about the dollar or any other currency? Not really. Over time, inflation eats away at the value of cash. But gold? It's like a rock in a stormy sea, steady and reliable. Let's also address a common misconception about gold. Some people argue that gold doesn't produce income like stocks or bonds, so they think it's a dead asset. But that's not the point of owning gold. You don't own gold to generate income. You own it as a store of value and as a hedge against risk. It's there as protection, not as a growth engine. It's your financial insurance policy. Here's another analogy. Think of gold as your fire extinguisher. You don't buy a fire extinguisher expecting to use it every day. You buy it in case of an emergency. When that emergency comes, you'll be glad you have it because it can save you a whole lot of trouble. That's what gold does for your portfolio during a financial crisis. It's the asset you can count on when everything else is burning down. Now, let's talk about some practical ways to invest in gold. You don't have to buy physical gold bars and hide them under your mattress, though some people still like the idea of holding the metal itself. But these days, there are more convenient options. You can invest in gold exchange-traded funds, ETFs, like SPDR Gold Shares, GLD, which tracks the price of gold. This allows you to gain exposure to gold without having to worry about storage or security. Another option is to invest in gold mining stocks. These are companies that extract gold from the ground, and their profitability is closely tied to the price of gold. If gold prices go up, the value of these companies often rises as well. However, keep in mind that mining stocks carry more risk because they're also affected by the operational success of the company, not just the price of gold. Now, you might be asking, should I put all my money into gold during a depression? The answer is no. Like any investment, gold should be part of a diversified portfolio. It's a hedge, not the whole strategy. You still want exposure to other assets like stocks, bonds, and even cash, but gold provides that safety net when everything else is under pressure. There's a famous quote by Ray Dalio, one of the most successful hedge fund managers in the world, that really sums this up. If you don't own gold, you know neither history nor economics. What Dalio means is that gold has been a reliable store of value for thousands of years, and it's outlasted every financial system ever created. It survived wars, depressions, currency collapses, and more, which is why it deserves a place in every investor's portfolio. So, let's bring it all together. What will you have learned by the end of this? By now, you should understand that gold is more than just a shiny metal. It's a lifeboat during economic storms, a hedge against inflation, and a store of value that has stood the test of time. You'll know how gold performs during crises and how you can add it to your portfolio through physical gold, ETFs, or gold mining stocks. You'll also have a clearer understanding of why gold, while not an income-generating asset, is an essential part of a smart, diversified investment strategy. And here's the final takeaway. When the next financial crisis hits, and it will at some point, owning gold could be the difference between sinking and staying afloat. Let me ask you one more thing. Are you ready to protect your wealth the next time the economy takes a dive? If the answer is yes, then you understand why gold could make a depression the best time of your life to be prepared, not scared. Enjoying it? Relax. We've got 2 more assets to uncover. Can you guess what the next asset may be? By the way, kindly subscribe, like, and share for more inspiring ideas the world has kept secret from you for decades. Oh, thanks for staying. The next asset to consider in times of depression is real estate, the long-term play. Real estate is often considered one of the most reliable investment vehicles, especially during economic downturns. It offers a unique combination of potential income, tax advantages, and appreciation over time, making it an appealing option for many investors. Why real estate works in a depression. 1. Tangible asset. Real estate is a physical asset. Unlike stocks or bonds, which can evaporate in value due to market fluctuations, real estate provides a sense of security. It's a place that you can see and touch, making it a more stable investment during times of economic uncertainty. When everything else is in flux, a property can serve as a safe haven. 2. Income generation. One of the key benefits of real estate investment is the potential for rental income. During a depression, while property values may fluctuate, demand for affordable rental units often remains stable. People may downsize or rent instead of buying homes, which can create consistent cash flow for real estate investors. This rental income can help cover mortgage payments and expenses, even when property values decline. 3. Appreciation over time. Historically, real estate tends to appreciate over the long term. While there may be downturns in the market, property values generally rise as the economy recovers. This means that even if your property loses value temporarily, it's likely to rebound over time, making it a solid long-term investment. According to Case-Shiller Home Price Index, despite significant declines during periods like the 2008 financial crisis, home prices ultimately recovered and exceeded their previous highs. 4. Tax advantages. Real estate investors can benefit from various tax incentives. Mortgage interest and property taxes can often be deducted from taxable income, providing significant savings. Additionally, real estate depreciation allows investors to reduce their taxable income while still benefiting from property appreciation. This can be particularly beneficial during economic downturns when cash flow is essential. Let's pause for a moment. Consider this. What if you could generate passive income while owning a tangible asset that appreciates over time? How would that change your perspective on investing during a depression? This is the unique position real estate offers. Real estate strategies for depressions. 1. Buying distressed properties. During economic downturns, many homeowners may face financial difficulties, leading to foreclosures or distressed sales. As a savvy investor, you can look for opportunities to purchase properties below market value. With careful research and due diligence, buying distressed properties can lead to significant returns when the market recovers. During the 2008 financial crisis, many investors successfully bought foreclosed properties at steep discounts. By rehabbing these homes and renting them out, they not only generated rental income, but also saw substantial appreciation as the market rebounded. 2. Investing in rental properties. Rental properties can provide a reliable source of income during economic downturns. Even if property values fluctuate, having tenants can ensure that you receive regular cash flow. Focus on acquiring rental properties in areas with strong rental demand and low vacancy rates. If you purchased a multifamily property in a location with consistent demand for affordable housing, you would likely continue to generate rental income even during economic hardship. This income can serve as a buffer against potential losses in other areas of your investment portfolio. 3. Consider REITs, real estate investment trusts. If you prefer not to manage physical properties, consider investing in REITs. These companies own and manage income-producing real estate, and they are required to distribute a significant portion of their earnings to shareholders in the form of dividends. This can provide a way to gain exposure to real estate without the hands-on management responsibilities. Reflect on this. Do you want to own physical properties and deal with tenants, or would you prefer a more passive approach through REITs? Understanding your preferences and lifestyle will guide your investment choices. 4. Long-term lease agreements. If you own rental properties, consider securing long-term lease agreements with tenants. This not only ensures a stable cash flow, but also reduces the turnover costs associated with finding new tenants. During economic downturns, tenants may be more inclined to stay put to avoid the hassle of moving, further ensuring consistent rental income. Real estate as a hedge against inflation. 1. Inflation and property values. Real estate has historically served as a hedge against inflation. As inflation rises, so do property values and rents. This means that while the purchasing power of cash may decline, the value of real estate can keep pace, preserving wealth. 2. Pass-through expenses. Many landlords can pass on rising costs to tenants through rent increases. In inflationary environments, rental income often rises, providing landlords with the ability to maintain or grow their income even as expenses increase. Consider an investor who owns a rental property. If inflation rises and operating costs increase, they may raise rent by 5% to maintain profitability. This dynamic enables property owners to keep pace with inflation while providing tenants with the stable housing they need. Now, fact finders, let's consider some challenges in real estate investment. While investing in real estate can be lucrative, it's essential to recognize the challenges that can arise, especially during a depression. 1. Market fluctuations. Property values can decline, particularly in areas heavily impacted by economic downturns. To mitigate this risk, conduct thorough market research and choose locations with strong fundamentals, like job growth and population stability, that can weather economic challenges. 2. Cash flow management. Even if rental income is stable, landlords must manage expenses diligently. During a downturn, unexpected repairs, vacancies, or non-paying tenants can strain cash flow. Setting aside an emergency fund specifically for your rental properties can help you navigate these challenges. 3. Regulatory changes. Real estate markets can be influenced by government policies, such as rent control or zoning laws. Stay informed about local regulations and consider their potential impact on your investment strategy. 4. Financing difficulties. During economic downturns, obtaining financing can become more challenging. Lenders may tighten their requirements, making it essential to maintain a strong credit profile and financial position to secure favorable loan terms. In summary, real estate is a long-term play that can provide stability, income, and appreciation, even during economic downturns. By recognizing the potential of real estate and implementing thoughtful investment strategies, you can build a portfolio that stands resilient against economic challenges, making it one of the best times to invest in this enduring asset class. Finally, fact finders, let's discover the asset that pays even when the market is down. Asset 3. Dividend-paying stocks, getting paid even when the market's down. You know, there's an old saying that goes something like this: in the short run, the market is a voting machine, but in the long run, it's a weighing machine. That's from Benjamin Graham, my mentor and the father of value investing. And what does it mean? Well, it means that over the course of a few days, weeks, or months, stock prices are more or less driven by popularity and market sentiment. But over the long haul, they reflect the true weight or value of a company's actual performance and fundamentals. Now, that's where dividend-paying stocks come into play. Think about it. If the stock market drops by 30%, and it might someday, markets always fluctuate, what would make you feel a bit better during those tough times? I'll tell you, getting a dividend check in your mailbox, or more likely these days, directly into your brokerage account. It's a reminder that no matter what the market is doing, as long as the company is solid, you're still getting paid. So, let's dive into this. Why should you care about dividend stocks during a recession or depression? Here's the deal. Dividends are the ultimate signal of strength. A company that consistently pays dividends, especially one that increases them year after year, shows the world that it has steady cash flow, solid profits, and a management team that's looking out for its shareholders. It's a bit like having a farmer in a bad year of crops who still manages to harvest just enough to pay the bills and feed the family. Let's use Johnson & Johnson as an example. They've been paying and raising their dividend for over 50 years. And they've done this through wars, recessions, tech bubbles, pandemics, you name it. If you own their stock during those periods, the share price might have gone up and down, but you kept getting that dividend payment. It's what I call getting paid to wait. You're collecting income while waiting for the market to rebound. But wait, there's more to it. Some people might ask, Warren, isn't there risk in stocks during a downturn? Well, of course, there's always risk. But dividend stocks carry a unique edge. Why? Because dividends tend to provide a cushion. When markets crash, the prices of dividend-paying stocks don't usually drop as hard or fast as those that don't pay dividends. Investors hang on to them because they know they're still getting that payout. regardless of what's happening in the broader economy. Here's a quick analogy. Think of a stormy sea. In that sea, a dividend stock is like a well-built ship with an anchor. The storm might toss it around, sure, but that anchor, the dividend, helps keep it from drifting too far off course. Now, let's ask an important question. Is there a catch? Well, sort of. Not all dividend stocks are created equal. You don't want to be chasing after a company that's offering a huge dividend just because the yield looks attractive. There's a reason why a dividend might be high. Often it's because the stock price is tanked and the market doesn't believe the company can maintain those payouts. A rule of thumb I live by is, don't fall for dividend traps. You want companies that have a long history of paying and raising their dividends, like the Procter & Gamble's, the Coca-Colas, and the Pepsis of the world. Here's a little story to drive it home. In the early 1970s, there was a deep recession. People were selling stocks left and right. But Coca-Cola kept paying its dividend, even increasing it. That's when I knew that was a company with a solid business model, a powerful brand, and a shareholder-first mentality. So I bought in. That decision has worked out pretty well, I'd say. Now, let's talk about a key principle: the dividend aristocrats. These are companies that have increased their dividends for at least 25 consecutive years. These are the blue bloods of the market. Companies that take their dividend payments as seriously as their reputation. Take a look at a stock like 3M, which has been paying dividends for over 60 years. Or ExxonMobil, which has a track record of increasing dividends through oil booms and busts. By the way, you can find these aristocrats listed on the New York Stock Exchange if you're curious. Here's a question to think about. How do dividend stocks help build wealth over time? Well, the key here is compounding. When you reinvest your dividends, you're buying more shares, which in turn generate even more dividends. It's like planting a tree. Over time, it grows, and you get more and more fruit. Albert Einstein once said that compound interest is the eighth wonder of the world. He wasn't wrong. When your dividends are reinvested, you're essentially putting that compound interest principle to work for you. And this is where you start seeing exponential growth, not just linear. So if I had to sum up why dividend-paying stocks can make a depression the best time of your life, it would come down to this. They provide cash flow during tough times, they give you an anchor in volatile markets, and over the long run, they compound into real wealth. Now, here's a question for you. What kind of investor do you want to be when the next downturn hits? If you're holding dividend-paying stocks, you can rest a little easier, knowing you're still getting paid while everyone else is panicking. Let me end with a quote from John D. Rockefeller, one of the wealthiest men in history. He once said, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in. That's the power of owning dividend-paying stocks." Wow, fact finders, you made it. Now, you have uncovered the secret that billionaires have hidden from you for decades. Can't wait to hear about your exploits. Stay tuned for our next episode.